To wrap up in our final lesson, we're going to just hit a few miscellaneous topics. The first that we'll talk about is the lower of cost or market. What happens when our inventory values fall below market value? Well, market value is defined as the replacement cost, not the sales price. So when we look at what we could buy for now versus what we bought for earlier, what we could replace it for, if that is lower than our cost, we will normally write down the inventory. We can do this in one of three ways: separately to each individual item, by major categories of assets, or to the whole inventory. Here's an example. A motorsports retailer has the following items in inventory. Let's look at the things that they have. The total cost was $170,000 of the Roadster. The Sprint was $50,000. Today, the market value of those is $140,000. So if we apply this individually, we're going to take the $140,000 as the inventory value. That would be the lower of cost or market, the lesser of the two. We look at the Sprint, and that number is $50,000 cost, $60,000 market value. We take that to the $50,000 lower of cost or market. So our inventory had a cost value of $220,000. It has a lower of cost or market value of $190,000. The entry that we use to write down that inventory debits cost of goods sold and credits merchandise inventory. What about inventory errors? Here we have a situation where either we've counted wrong, we've entered something wrong, we have our inventory number incorrect. If our ending inventory is understated, we forgot to count something, okay? So we have a value that is less than what it really is. Then our cost of goods sold will be more than it should be, and our net income will be less than it should be in year one. However, by year two, that reverses itself, and the cost of goods sold then is less than it should be, and the net income is more than it should be. So by the end of that 2-year period, that evens out. Let's say that our ending inventory is overstated, then the reverse happens. So in this case, we have a value too high. Maybe we had a decrease in market value, maybe we counted something twice, whatever the case might be. Then our cost of goods sold is not as much as it should be, and we're reporting more net income than we actually have. By year two, now our cost of goods sold is more than actual, and our net income is less than it should be. Now, if our mistakes are not material in nature, that is, they don't affect the financial statements in a way that would make you make a decision that is different from the one that you're currently making, not material to the financial statements as a whole, then this probably isn't a big problem. However, remember the matching concept. We try to match our revenues and expenses in the same period. So when we have our ending inventory not correct, we're not quite doing that. That's what happens in these year one, year two. It smooths itself out over the 2-year time period, but we have the amounts not correct for the individual years. There we go again, the financial statement effects of the inventory errors on the balance sheet. And now let's take a look at inventory turnover and days sales in inventory, another one of our analysis that we'll take a look at. The first one shows how many times a company turns over its inventory during a period. It tells us how well the company is controlling the amount of inventory available. It costs money to have inventory, right? So our inventory turnover is the cost of goods sold divided by average inventory. So we want to have enough inventory so that we don't run out, but we don't want to have too much that we're sitting on excess inventory that may or may not become obsolete. Our average inventory is our beginning inventory plus our ending inventory. We're going to take the cost of goods sold divided by this number. Our days sales in inventory reveals how many number of days sales we have on hand. So we'll take our ending inventory, divide it by the cost of goods sold, and multiply by 365. Let's take a look here at Costco and Walmart. Cost of goods sold for Walmart and Costco, and we can see our inventory turnover for Costco is 11.9 times. So the more, the better. They're turning over their inventory more times than Walmart. Their day sales in inventory are 32.1 days, which is also less than Walmart. So it appears that Costco is a bit more efficient in managing their inventories, or it's just the different types of inventories. Costco probably has more perishable goods than Walmart. All right, let's take a look at our last problems here. We're going to do 5, 18, 19, 20, 21, and 22 in the QS section. Take a look at those on your own and then come back to work through them together. QS 518 is asking us to identify which method of costing inventory describes the statement the best. Results in the highest cost of goods sold. And I think we're supposed to assume that prices are rising. So it results in the highest cost of goods sold. That is going to be the LIFO, last in, first out, because we're going to be costing at the higher value. Yields the highest net income, that will be FIFO. Yes, assume a period of increasing costs. Has the lowest tax expense because of reporting the lowest net income is LIFO. Better matches current costs with revenues. That is LIFO. They're the ones closest to actual. And precisely matches the cost of items with the revenues they generate is the specific identification method. The other problems are on the number 7. Let's take a look at those. QS 519, we're to compute the lower of cost or market for each individual product. Here we have a mountain bikes, skateboards, and gliders. The mountain bikes had a cost of $600. Their market value is $550. So the lower of those is the $550. So I'm going to multiply that out. 11 times $550, lower of cost or market, $6,050. Now you could do this with, you could do a total cost, a total market, and then come up with your low of cost or market, which I believe is how I have you doing it in the homework. In this case, the skateboards are, the cost number is the lowest. And in the final, the gliders are the lowest. So we just go through and pick out the lowest of the two, cost or market, and assign it to that inventory item. All right, so 28,800. Now we would compare that to what we had. That's why you would want your total cost in here. You would compare that to your total cost number, and your entry would be to debit cost of sales and credit merchandise inventory. What happens in year 1 if the cost of goods sold to the cost of goods sold if inventory is understated by 10,000? Cost of goods sold will be overstated. Net income will be understated. By year 2, cost of goods sold, understated. Year 2 net income, cost of goods sold would be overstated. In QS 521, we're being asked to calculate the inventory turnover. I'm going to do that by taking the cost of goods sold, and I'm going to divide that by, you can actually use the average command in Excel. I'm going to divide that by the average of the beginning and ending inventory. And I get 7.5 times. Day sales in inventory is going to be the cost of goods sold, or excuse me, the ending inventory divided by cost of goods sold. So ending inventory divided by cost of goods sold times the number of days in a year, 365. So get 54.75 days in inventory. The last one, which we didn't talk about in the video, but this is called the gross profit method. And I think in this problem there was a fire, so we're not sure. We're trying to recreate the amount of inventory that might have been on hand prior to the fire for an insurance claim. So we're going to estimate the cost of that inventory that was destroyed. We're going to start with our beginning inventory, which is 190,000. We're going to add in our purchases. And remember that beginning inventory plus purchases equals goods available for sale. And of my goods available for sale, I either sell them or they become ending inventory. So here's where we're going to estimate that cost of goods sold. I'm going to take those goods available for sale and I'm going to multiply those by 1 minus the gross profit rate. If the gross profit rate is 44%, that means that I paid 56 cents of every dollar for the good that I'm selling. So I come up with cost of goods sold of 303,520, and my ending inventory then is the difference between the two. Oh, hold on, I made a mistake here. The cost of goods sold number, I don't know why I took goods available for sale. It's the sales number. So this needs to be the sales number times 1 minus that gross profit rate. So for every dollar of sales, I have 56 cents as the cost of the product. I said it right, but grabbed the wrong number, so I apologize for that. So cost of goods sold is 383,600, and that gets me a good estimate of my ending inventory of 158,400. And that is the end of this module.